Welcome back to the Property Trio. I'm Dave Johnston from Property Planning Australia, and I'm joined by the always insightful Kate Bakos, the data nerd himself, Mike Mortlock. Today's episode is about related traps we see investors fall into, relying too heavily on suburb-level data and chasing so-called bargains in the bottom quartile of property prices. Kate, you wrote a blog recently on the dangers of investing in the cheapest end of the market. Tell us what prompted that.
Well, I will, but I want to preface that by saying I'm just loving hearing the birds outside your caravan, Dave. Yeah, Dave's office is has four wheels, and it's currently halfway up the coast of Queensland. I'm so inspired, David. You've got the kids out playing, and Sarah's disappeared and left you to turn the caravan into a podcast studio. So thank you to your family.
Yeah, look, it's been a pretty action-packed fortnight heading up the middle of New South Wales, Queensland, outback. We've decided to come in to the coast, and we're on the Sunshine Coast, and I'm glad you could hear the birds. I was hoping they'd come through. And I tell you what, the magpies are really friendly, too friendly, to be honest. There's a band of 5 to 10 of them that come and eat your food every night.
I can hear them wobbling.
It's nice on the
way. It's good to have you back with us because Mike and I have gone duo on a couple of the eps and we've missed you. And this
Done a
one,
great job.
We have a bit of fun, but it's not the same. This one was prompted by an article I recently wrote, and I was prompted to write that, as I am with blogs, when there's a repetitive situation that I'm dealing with. I sometimes think it's time to write about it.
Yeah,
and it's come from seeing way too many investors, particularly first-time investors, getting lured by slick data reports that aren't always telling the full story. And that's not to say that data reports out there are all slick and not full of substance, but there are some that are not. And many of these reports promote locations that are offering entry-level priced houses in locations that are either low socio-economic demographic suburbs or in regions that have limited long-term growth drivers. And when people look at property trading, that's very short-term. And to differentiate my philosophy and approach to property, we always talk about the long term. So for traders who are happy to jump in and out and write off the CGT and write off the stamp duty, they might be making a small gain here and there, but it's not what I like to rely on. So the short-term returns can look good to investors, and some of these locations are unattractive to owner-occupiers, and that's the big thing that today's episode is all about. People think that they've snagged a bargain, but they've actually picked up a property that could spell trouble. And the bigger issue is when investors flood a small area and property values are driven up sharply by investors in this short period. The herd mentality isn't great for the last investors who jump onto that bandwagon.
This is a very
100%.
Interesting thought experiment, isn't it? And we're seeing that a lot, and I would categorise 23-24 as the rise of the affordable markets, and some of those markets that did so well are no longer affordable. But I'm wondering, can we deep dive on this, Kate? Are you saying that these cheap sort of metric-driven markets are more likely to be sort of short-term growth and something that you would want to invest in if you got a 15 or 20-year plus time horizon?
Well, some of them are just a flash in the pan, Mike, and that is the concern. Long-term growth drivers is something that I'm always looking out for. And not all suburb data reports are alike, and you'd know that more than most people. I'm familiar with some of the work that you've done with Kent, for example, and Kent focuses on several layers of research, which he terms the 4 pillars. And we'll chat about that a bit later on. But circling back to the suburb data, it can be as lacking as median price movement. I remember the days when I was in my early 20s and I'd get really excited about the new release of the API magazine each month, and I'd go straight to the tables at the back and look at what's delivering really exceptional capital growth performance in a short term, which is a ridiculous thing to do, especially looking back at my younger self now. But I remember one month I circled a suburb called Mortlake because it had just done really well, and with crazy enthusiasm I jumped onto the internet, and that was before the days of having data at our fingertips like we do now. But I wanted to know a bit more about Mortlake, and it had less than 1,000 people living there. It's a small town in the Western District, about 3 hours from Melbourne. And the following month, Mortlake's median growth figure wasn't that great at all. So it was a fast lesson in data sets for me. It's about not just data integrity, but data points. If you haven't got very many data points, then you've really got to ask yourself what that short-term data is actually telling you.
I think we might have driven through Mortlake on the way to Swan Hill from Cobden.
Yeah, well, that's the thing.
Very small little, country town.
That's right. Yeah, we have a lot of information at our fingertips, but unfortunately, a lot of people don't invest the time interpreting the data or managing that data integrity, and blindly following data can lead to regret.
I had a podcast a couple of years ago where we actually looked at those top lists from the property magazines and just made a show out of sort of having a go at them, because like it's clear that nobody's checking it. It's just they're just running a report like which median grew the most in which SA3 region. They didn't look at segmentation. They didn't look at transaction volumes or anything like that, and it's ridiculous, really. Kate, your articles, they talked a lot about the micro, for example, the house or the neighbourhood itself. Can you unpack that a little bit for us?
Yes, of course. The biggest issue I've got with suburb data is the generalisation of a postcode. One suburb doesn't equate to one set of characteristics. We all know that. And we have to then consider the individual streets and then the individual houses. And for the past year in some of these hot suburbs, I've seen interstate buyers agents' purchases haven't actually met the interstate buyers agents because a lot of them are buying sight unseen. Some of the houses that they've purchased have been awful, whether it's dodgy streets and pockets or houses with building issues. And presumably the building issue bit is sorted out by a good building inspector. And I know that some of these advocates do buy them sight unseen and leave it up to the building inspector. But the concern that I have is about the dodgy pockets, because building inspectors aren't paid to look out for that. Some of them might not care, some of them might not understand the experience, and some of them might not pick it. So I think there's so many limitations to that sight unseen model, but I digress because this is actually about relying on suburb data.
Yeah, it's a really good point, Kate. And, like we've talked about for a long, long time, it's one thing to pick a quality suburb. It's another thing to get the right property in the right street, in the right pocket. Every suburb is going to have quality assets and weaker assets. Not all properties are the same just because you've landed on a suburb. And, that's possibly, and that's exactly what you're talking about there. And possibly that's some of what's occurring in Darwin at the moment, where interstate buyers agents have picked maybe a quarter of the suburbs in the city of Darwin, and they're just picking up any property in those suburbs. And I think, we're going to see a big boom there, but then we're going to see some pain in the long run with some of those properties, like you've described here. So, Mike, you've tackled a similar issue with how people interpret data, especially suburb medians. Why do you think so many investors get led astray?
Well, I think we've learned to trust the median to some respect, because we do it ourselves every month. We talk about the median value changes in capital cities across the country. We typically don't talk about individual suburbs medians, and I think that's a safe approach, because median kind of makes sense when you've got a huge sample size, right? If we're talking about Sydney, like the median, we talk about this as well. You can't buy the median, but as a reference point, like the median going up and down at a city level, it is meaningful, and it's kind of the best that we've got. So I think we've been trained to focus on the median, but it's way better than looking at a mean or an average, which is really susceptible to the outliers. Like the median is more kind of the midpoint, but the big problem is that it just doesn't show things like distribution, variance, or even in property types. So It depends really, and I talk about this whenever we talk about median, I talk about the segmentation, because that's the thing that really makes it crazy. And the problem that you see with these magazine style metrics where, okay, well, it's gone up 70%, but there was just fibro cottages, and now there's newer housing estate that's got 4-bedroom, brand new homes that are selling for, an extra 70%. It's going to look like that suburb is just going through the roof, but it's just a different type of stock that's come onto the market and it's selling at a higher price point. So it can be very, very misleading.
Yeah, and it's more distorted the less sales there are in that location, which is a really important point for our listeners to understand. So,
and you know what? Just a council planning change or a new subdivision, new set of rules, that can be an absolute game changer for a suburb. Like you mentioned, Mike, I remember when people were jumping onto these brand new suburbs that we weren't even familiar with the names of, because they'd delivered this crazy growth. And all it was, house and land packages going and the data being recorded. Does that make it a good area to invest? Not at all.
So true. So, Cate, how do you guide your clients when they come to you with suburb medians as a starting point?
I help them shift their focus to the dwelling types and the neighbourhoods that appeal to owner-occupiers are in high demand. Because ultimately, when an agent rings me and says, I've got a really good investor property, it's probably something that owner-occupiers don't want. And they think that an investor will buy, the crappy little thing that might give you high rent. And I have to correct them. The best investment properties are the ones that owner-occupiers really want, because it's that emotional, the emotional need to get a property and the willingness to fight for it that drives values. And all that means is proximity to amenities, lifestyle drivers, walkability to things that matter, floor plan functionality, and even things like natural light and street appeal. They can get an owner-occupier really excited. And you can't see any of those attributes in a median stat.
Yeah, I guess the psychology of it is owner-occupiers are going to be really discerning most of the time about the characteristics and attributes they want out of their property and their location. And so that's why, as a general rule, they're going to be more particular with the properties they select, and therefore, there's going to be less duds in there in those types of properties and locations. Mike, what kind of data should investors be looking at if they want to go beyond medians?
Well, again, we probably can fall into the trap of some of these metrics being short-term ones. But if we're wanting to look for something that has, short-term fundamentals, we need to look at dwelling types. So a 2-bedroom unit's going to behave very differently to a 4-bedroom house. Sales dispersion, that's a big one. How wide is the gap between the lowest and highest sales in the suburb? That's going to have the data dancing around. Things like days on market, vendor discounting, percentage of stock on market or inventory, they can give you a better idea about the supply and demand dynamics that a median kind of doesn't really give you. And just to take up Cate's point on the best investment properties being things that owner-occupiers want. Owner-occupiers don't care about those flash-in-the-pan metrics, the days on markets, the vendor discounting. They might look at it when they're going to buy just out of interest or to inform their negotiation strategy. But if they want to live there, they want to live there. And think about this as a thought experiment. I'm pitching 2 investment properties to you, Dave. One of them, I say, okay, when you sell this, you can sell it to one of these 10 people, or this particular one, you can only sell it to 3 of the 10 people. I mean, that's the difference between an asset that has owner-occupier appeal and investor appeal to investor only. It's not just that owner-occupiers are more emotional, which is absolutely true, Cate is right, but the supply is bigger. So you're actually constraining down the amount of competition that you could have when you sell that property if it has no owner-occupier appeal.
It's a really good point. It reminded me of something I used to always say a lot, but I don't say too much anymore. But ultimately what drives property values is the number of people who want to buy that specific property.
That's it.
That's it. And, that's people need to remember that.
Totally. And back to your point, Mike, with some of those attributes that you're looking for, the metrics. Let's not forget about zoning and overlays. I've seen investors buy into areas thinking they're buying in a great suburb, but the specific pocket they've bought is either flood prone or restricted in development, or it might have future compulsory acquisition overlays, which is something that I'm very attuned to, especially in the Melbourne market, in our inner north and northeast, for example, where we still have main roads and subdivisions dictating where significant arterials will go. So these invisible issues can be very concerning, and they're not picked up in a legal review unless they specifically impact the title itself. So for argument's sake, let's say a freeway extension is going to run through the area and the house next door is impacted by the freeway, so it has a compulsory acquisition overlay on it, but not the house in question. That literally means that a freeway will go in right beside your property and the fence will likely be a sound barrier. Now, this can't be picked up if someone doesn't delve into the planning schedule and have a look at whether the neighbouring houses or the neighbouring blocks are going to be impacted by overlays. And in a contract, they aren't showing all of that. So it can't always be picked up in a legal review. Due diligence counts for absolutely everything, and not everyone knows how to conduct it. But if you're buying sight unseen and relying on a median report, you need to know this stuff.
Yeah, and that type of situation was set a shutter down the spine of a lot of our listeners, that you could unwittingly end up buying a property that is going to be sitting smack bang next to a freeway or something unseen like that, where, a lot of them will think, well, how do I do the due diligence to even find that information out? So these are the
I
types
subscribe to town planning programs, and they cost a fortune, but that's part of what I do. I'm a buyer's agent, and I'm giving people advice and doing the due diligence as thoroughly as I possibly can. And in the northern suburbs of Melbourne, there are so many blocks that are affected by this. I know if I did a search right now in Thomastown and Laylaw, I would be rejecting plenty of properties that are sitting next to these compulsory acquisition overlays or too close for comfort. And people don't all know about it.
Yeah, and there are a couple of suburbs that have had a lot of investors go into over the last 10 years or so as well. So look, that sounds quite scary, Kate. Let's come back to this idea of bottom quartile properties, which certainly has been quite popular. And so it's probably an interesting topic on its own. We might be able to do a podcast on, I reckon.
I think so.
Whether that's something to stay because of the higher values of properties, particularly in major capital cities. But won't digress too much. Why are these properties so often avoided by home buyers, the bottom quartile of properties? Kate?
Well, they're not necessarily avoided, but we have to recognise the difference between affordable and aspirational. And that's a big concept, but it's simple. And when you've got people going for something because they can afford it, they won't be approaching it like a cashed up owner-occupier will. First home buyers might select the lower quartile options because they recognise that they have to start somewhere. So for them, it can be affordable and not aspirational. But when it comes to strong owner-occupier appeal that drives market growth, we have to step into the shoes of aspirational owner-occupiers. This is because owner-occs are typically buying with their hearts and heads. If something feels off, like a dodgy neighbourhood, a noisy street, a poor floor plan, or even an undesirable orientation, they just won't compete for it. If they're not competing, the price growth will stagnate. So even if a property has high rental yield, it's a false economy if the long-term capital growth is poor.
Yeah, so high yield can often be just a result of the low purchase price, right? It's not necessarily an indicator of strong rental demand. And you can have a 6% yield on a property that doesn't grow and it be a bad investment property. I mean, we're talking about gross yield, not net yield. And even if it is cash flow positive by a few bucks, if it's not going up in value, I'd much rather have a negatively geared property that's doing, 6 or 7%. A 3.5% yield on a property that doubles in value every 10 to 12 years is going to be way better than one that's going to give you $50 a week but goes nowhere from a price point.
Yeah. And extrapolating out of those numbers, if you buy a property, really low value property, it's probably more likely to be in a really small town, regional Australia, probably fairway inland. You might be getting yields of 6% or above, but the value of that property will be probably be very similar in 5 years, 7 years, 10 years. In the reality, over 5 to 10 years, you've pretty much made no money. Even if you were, and people look, okay, well, I'm slightly negatively geared only, so it's more affordable, I've got a high yield, maybe even neutrally geared, but you're in the same financial position 7 to 10 years later. And that's the hard thing to fathom, that growth in the value of the property and the growth in the rent and how that changes in time. And that is what catches a lot of investors out. So what advice would each of you give to someone just starting out and trying to make sense of the data they find online? Look, that's a really big question, but we'll talk about
it. Is
I'll narrow it into suburb data in particular, suburb data they find online.
I'd say start with a clear goal and then look at quality over quantity. You want to avoid buying just because it's cheap or popular with investors at the minute. You've got to ask yourself, would I live here? And more importantly, would lots of other people want to live here? And that's a simple statement, but you've also got to put yourself in the shoes of the target purchaser. So I might be looking at areas that, it's impractical for me to live in an apartment right now. I've got a daughter who takes up a lot of space and a husband and stuff and cats. And so apartment life isn't something that I would be thinking about right now. But when I walk through an apartment for an investor, I'm channeling myself back to when I was 25, thinking, would I get really excited about this apartment when I was that age? And, are there any red flags, anything I don't like, anything that's not working for me, like with floor plan or lighting or accessibility, whatever? They're the questions that I ask myself. Could I live here at the same age and stage of life? And would lots of other people want to live here?
I think the goal is a critical starting point. We've done whole episodes on that, right? And I think the way that I worry some investors are doing is like, okay, well, I've got this borrowing capacity. Now let's look at which suburb has got the best data. And we've already unpacked ways in which the data can kind of be misleading. So I say treat the data as more of a discussion point, a conversation starter, rather than a conclusion. That because you can filter yourself down. I often kind of think about, it's almost like a dating app metaphor. It's like, I'm looking for a person. They must be 6 foot tall. Well, what if they're 5'11" and they're just the best person on earth for you, and you filter them out by 1 inch?
It's a great height.
Yeah, I know. It sounds too close to home. I am
It's a
slightly
fair
taller
market,
than
though, I
5'11".
think under 6 foot, pretty much cross them off. For the females.
Well, I think.
Are you 5'11", Mike? No.
I am.
I'm bang on 6, so I come off all right on this particular one. But the point I'm making is that, like, a lot of these programs, that's kind of how it works. It's like you set your budget, you set your filters, and the magic can often happen, 0.5% in outside the yield filter that you do. So it is actually dangerous to kind of restrict it straight down. And, you don't want to make a rush decision. And if the data looks like it's crazy and a bit too good to be true, then we've already sort of shared reasons why that might be the case. There could be different types of properties selling. And the data that we get, we need to understand that it can often be quite lagged. Like if we're talking about totality or ABS, certainly ATO data, which we did the other day. And then also the data might look great for the next 3 months, but then it could actually disappear, and you're buying a little bit of a blip on a radar screen than rather necessarily long-term metrics that deliver. And we're going to talk a little bit about some of those.
Yeah, and look, data is such a ubiquitous term, as I sort of alluded to in the question. I mean, a piece of data may be that market's been running for 3 years and you're getting in now. The data still, it looks fantastic, but are you getting in? Most markets overshoot on the top end, so that means they have a bit of a correction and they flatten out for a long period of time. And that's share markets, property markets, etc. So there's all different elements of data to factor in when you're looking to purchase a property, and they're not all weighted equally. And that's what it's just like life. We seek advice from people. I'm seeking lots of advice from grey nomads about caravanning everywhere I go, and I'm picking their brain. Anyone I can talk to, and so I've said to friends, we've gone from being absolute novices to, I think, beginner level over the last 2 weeks. And that's probably the same with a lot of property investors in your early stages. So it's also about choosing which advice or data you take on board and which is valuable. Look, guys, that's fantastic advice. Now, Mike, Cate mentioned your data discussion with Kent and the 4 pillars. Kent developed a methodology based on how often real estate agents mention lifestyle features in property listings. Using AI, he scanned national listings and bucketed recurring themes into 4 key lifestyle pillars. The 4 pillars were beach, so proximity to water, a timeless draw card, nature, parks, riverside trails, green spaces, urban, access to shopping centres, clubs, restaurants, etc., family, schools and educational institutions. Now, he treated these with each with equal weight, forming a balanced scorecard for lifestyle appeal. Areas that scored well across all 4 pillars were highlighted for their enduring attractiveness. So, and just on this point, I mean, obviously, all 4 of these 4 pillars are not equal in every situation.
No, especially where you are. Yeah, like if I went into Fitzroy, you're not going to get excited about nearby schools because most people aren't families.
Yeah, or the nearby beach.
Yeah.
So this is the point. Like, you can't mold data to be perfect, and that's some really important point, which whenever we're talking about data, we always try to get across. But what were some of the findings that you uncovered about this approach with Kent, Mike?
Yeah, it was an interesting kind of thought experiment about what's different about, say, markets that have some of these more lifestyle elements, or these, let's just say, these draw cards, and they must be draw cards. Otherwise, why would real estate agents en masse be mentioning in their listings? Like they do put in there what they think is most important about that area and that location, and those were the main things that we saw being highlighted. And the markets that perform, like the markets that have those pillars, perform very different to the data markets that we're talking about. The ones that have, like we see the inventory plummet, the days on market, the vendor discounting, these all tighten down. They're very, very good short-term indicators of property market performance, but those markets behave very differently to ones that have those pillars. So if we look at some of the findings, like say top suburbs, Warringah, so like think Manly in Sydney, Townsville, and lots of parts of Perth showed strong 4-pillar performance. Townsville was a little bit of a surprise because it has been one of those spreadsheet darlings. It has popped up in the data, but it also scored very well on the lifestyle factors, suggesting it's not just a spreadsheet style market, a flash in the pan market. WA suburbs were underappreciated but showed strong fundamentals on proximity, amenities and balance. I think WA is just a bit problematic given that it's right at the peak of its market. But yeah, those were some of the ones. And if we think about some of those markets, like especially the blue chip ones, like around Manly, I mean, that's always a market that's done well. It's grown over time. It's always going to be in demand for a lot of those reasons.
Yeah, it's a really interesting way to look at investing, and I'd love to delve more into Kent's research. I know he's a clever fella. Like any set of algorithms, there's a lot of value to be had in some of those markers. I noticed that you both discussed all-rounders, which seems to have a more long-term focus. Nobody really wants to purchase a property that flatlines after a burst of growth, and nor do we want to pick an area that's lacking with lifestyle appeal or highly sensitised to interest rate movement or migration patterns. So there's so much to suburb selection, but I think intimate knowledge of a suburb goes a long way.
Yeah, absolutely. You make a great point. You can't just look at data on a spreadsheet and then go, okay, well, everywhere in that suburb is created equal. The boots on the ground, local knowledge, it counts for a lot. I think in investors who are data driven, and we are all data driven to some degree, but if we're just looking at those flash in the pan short term metrics, we need to be prepared to zoom out and look at some of the lifestyle fundamentals, those things that, as we were talking about, disproportionately attract owner-occupiers rather than investors. Because does an investor care that there's green space in an investment property that's 1,000 kilometres away from where they live? Well, no, but the owner-occupiers definitely do, and the tenants do as well. That can make a big difference. So the lifestyle fundamentals are themselves what will matter in the next 10 or 20 years, not what the metrics are saying right now.
Yeah. So last question before we go into our gold nuggets. Can each of you give me one red flag when looking at either data or cheap properties, which are sort of circling back to where we start, that bottom 25% quartile of properties?
Ooh, a good question, Dave. I've actually got two red flags. The first one, if the days on market are ridiculously tight when compared to the adjacent suburb that has similar attributes, you have to ask yourself if the competition you're facing is predominantly investors and if they're being driven by some kind of hot suburb report. Because I've seen that happen. I've seen two suburbs that could demonstrate growth in their own steam, but one of them's been on a hot report, and it's had a flood of investors for the short term. And if you're paying over the odds, you're putting yourself at risk, obviously, with being underwater when things settle down and the next hot suburb comes along. But also you could be getting something that's equally as good for a far lower price and getting obviously better gross rental yield then if you look at the neighbouring suburb that's got all of the same attributes. And my second red flag is cheap doesn't equal value. You have to be suspicious of a deal that looks too good to be true. It often is.
Those are very good points. I want to add about supply constraints as well, because these place artificial pressures within markets, and without understanding them, you're kind of not knowing which way the current is going. And I think that's pretty important. You know, things like heritage overlays, limited land releases, zoning limitations, they always choke the supply, and of course demand will exceed it if that gets sort of, screwed down. So always view that data within a context, not as isolation. There needs to be a background and an understanding about what might be the reason why it's blipped up or it's shrunk down.
Love it. Thanks, Cate and Mike. That's all we've got time for today on the Property Trio. This one was packed with useful reminders for investors. Don't be seduced by cheap price tags or simplified statistics. Instead, always chase quality data, context, and long-term fundamentals, and ultimately, quality property. And remember, property investing is about quality, not quantity. So, although quantity and quality together is fantastic. So, before we wrap up, we'll go into our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
I'm going to kick this off because it is a subject dear to my heart, and I'm seeing a lot of activity from interstate buyers agents who cover all of Australia, who aren't intimate, or I'd argue some of them aren't even mildly knowledgeable with areas. I met one person in my travels whose BA didn't know which side of the city their asset was on, which is a bit of a problem. But I would definitely encourage people to explore and delve a little bit further. If they're engaging with a BA who is reliant on this suburb data, how much are they questioning the data? How familiar are they with the area? And how many other clients are they placing in that location? And how many colleagues in their team are working with clients who are also going into that location? Because it doesn't matter how exciting a report looks. If 20 people are trying to buy in 1 week in the same area with the same data report, there might be an issue with the selection of the asset.
That's a really interesting point. One thing that I learned from spending time with buyers agents over the years is I didn't really understand exactly how the business model, but I learned about competing briefs. So, for example, if you've got a brief for a sub $700,000 3-bedroom investment property in a certain suburb, well, then that's kind of like you locked out until you close out that particular person. But if you're working with a location-based buyer's agent that does a reasonable amount of volume, like they can't run their model like that. They need multiple people. So it's kind of like, okay, well, how do I get to the front of the queue? Is it am I getting there because I'm not asking as many questions, or I'm not sort of saying like, oh, it looks like there might be a bit of a red flag here with a zoning issue. I think that's something that a lot of people don't necessarily understand. And to circle back to a point all three of us made, if I'm getting I'll call this 1.5 gold nuggets. It like we don't buy an investment property thinking like who's going to buy it from us down the track, because that's like we kind of want to sit on it, we want to hold it, we want to get the growth. But that's what's really important. And along that journey, we want a valuer to revalue that property. And what are they looking at? Well, they're looking at what it would go for sale at that particular point in time. Even though you're not selling it, its sale price at that point in time is important. And that's where the owner-occupier appeal makes a huge difference. And often these spreadsheet style investment property hotspots are not owner-occupier focused.
Yeah, and that competing brief one would be a really good one for us to unpack further at a later stage for our listeners.
It's an
to
awful
understand.
thought.
Yeah, because it's obviously happening
Yes.
a lot of places in high volume buyers advocacies, and we obviously had buyers agents for about 8 years, and that was something we'd always still steer clear of. We'd never have competing brief.
You can't.
You don't have one of your clients competing with another client. Yeah,
No.
Exactly. So
And you can't have your colleagues' clients competing. It's a really awful scenario. I've heard situations where people have a limited amount of time to say yes to a property, otherwise it's passed on to the next person in the queue. All of that high pressure stuff doesn't rest comfortably with me.
No, that's selling more than asset selection, isn't it? It's where's the line? Look, at my gold nugget is about the psychology of when you're looking to buy an investment property. I mean, ultimately, one of the things you want to just have in your mind clear is the number of people that would like to live in your property on that street in that location is ultimately what drives up values. And to just make this clearer, there's a reason suburbs like Double Bay, Darling Point, Toorak, and Cottesloe in Perth have the highest median values in the country. Mayfair, the Monopoly Board in London, because everyone nearly in the country would like to live in those suburbs if they could afford to. Okay, and so that's why those properties' values have driven up the most over the last 50 years, 75 years, 100 years. And so if you always want to overlay your thinking with this simple fundamental fact. And when you lose sight of this sort of simple fact, when you're looking to buy an investment property and you start to, lose sight of the forest for the trees, that's where things go wrong. Okay, so just remember this fact that whatever are all the points, someone might be making to you, or you're getting lost in the sea of data, just remember the underlying factor that's going to drive up values is how many people in Australia, and some who haven't moved to Australia yet, would like to live in that property, in that street, in that location. That's going to drive up your value and your rent over the coming 10 years, 20 years, etc.
Well said, Dave.
Awesome.
So on that note, we will bid you adieu. My first.
I look forward to the next destination
on the caravan. It's
very
been
cool.
Really good to catch up with you both and just feel a little bit of normality after 2 weeks of mad
Being on the
traffic.
road.
Being on the road. Yeah.
Well, good on you, Dave.
Safe
Well,
travels.
I'll send you a message. We can have a virtual wine.
That'd be great. Maybe
Safe
you might even
travels.
join us too, Mike.
Sounds smashing.
All
Any
right.
excuse, mate.
All right. Have a
See you
great
next
week,
week.
Dave. See you
You too.
guys.
Have a good week, guys. See ya.